Добрый день,
Very,
Стен.
very good morning to you. Good day to you, Steen. So here we are, and I'm here to discuss several important topics that are high on everybody's mind, and this could be powerful drivers for the next stock market move. So if you're up for that, let's begin.
I'm always ready to talk to you. It's a great honor to be back with you. And I love talking to the Russian speaking clients around the world.
Спасибо. Начнем
Thank
с
you for your kind
самого
words. So let's start with
банального
the
факта,
basics. Well, the
который
number one factor that is
утверждают
currently
и
being
все те,
discussed,
кто об
and
этом ведет
the
определенную
depth and the
работу,
breadth of
это
this discussion is
наличие
happening
волны
in waves,
повторения,
which is
неважно,
the
как ее
next
назвать,
wave of
третья,
pandemic, number three,
четвертая,
number four,
это там и так
delta,
далее.
whatever you
И
want to call it.
лично для
So for me
меня,
personally, when it comes to pandemic,
как бы я
I sort of
недооценил время,
underestimated
насколько
the power of the
сильнее будет
pandemic.
несколько
I
этапов
didn't see
влиять
that
на рынок.
coming, to be
Сейчас,
honest with you, in
соответственно, это
2019. I didn't know that this would, have such a
появились
major impact on my
такие достаточно
strategy. And
массовые
now, I mean,
утверждения,
there's a
что
lot of
вакцинация
sayings
могла
that
поставить для
vaccination could
нового
actually
витка подъема
actually cause another
заинтересованности
wave of
кредитных
vaccine.
ресурсов.
Some financial institutions, some governments are saying
Если
that vaccination
предположить,
can
что
cause
действительно
another
просто
mutation.
курсом был бы окончательно решен,
Imagine theoretically
какие
that we're
белые лебеди
done
могли бы появиться в
with the
мировой экономике?
coronavirus. What white swans could actually appear on the horizon for the global economy?
So, if the precondition here is that we don't have additional COVID 19 setbacks, then we move on to the next agenda, which I think is the critical one for all of your viewers and investors. And that is you need to realize that the physical world today is too small for the political aspiration and the massive amount of political capital being put into the climate change and overall this very elusive term, which is the ESG, which of course is environment, social, and governance. Estimates now is that by 2025, $50 trillion will be under management in ESG products, with the focus on environment being climate. So, first off, I want to say that we need to embrace this because this is similar to what we saw with the euro, that people was raising questions at all times about whether the euro would survive, but we underestimated the political capital and willingness to do whatever it takes, in the words of former President Draghi. Similar with the climate debate, in Russia, in Denmark, we can be critical, but rest assured that all political capital, all allocation of capital going forward will be in some way or another be measured up against what it does to climate, what it does to ESG. So this is the single biggest, whatever it takes, political project, and that will absolutely, in my opinion, drive one thing and one thing only, and that is that we get too much inflation. Because again, look at it, we haven't even started this journey, but the inflation rates are coming through the roof. We are looking at a energy crisis across the globe. Electricity prices are all-time high. So for me, this is what we talked about last time. Inflation is not only here, but is actually still accelerating into a narrative, which is that we have transitory uh, impact on inflation coming from the opening up and closing down of COVID-19.
Ну, по инфляции у нас в России
Well,
есть большая
speaking of
проблема,
inflation in
потому
Russia, well,
что
first of all, we have this
инфляция
perpetual Russian
но
inflation,
доллар ушел, больше
but
всего
every
в
Russian
России
mostly
инфляция.
cares about the US
Поэтому
inflation somehow,
уточнить,
surprisingly.
наверное,
So when you
ввести
say inflation, you
инфляцию
probably mean
вообще
inflation
всех
globally, right? Not
мер
just
по
Russian, but
повышению
just global
материального
inflation of all assets with regards to physical assets, right? That's what you're talking about.
Exactly. That is even more eloquent than I could put it myself.
Тогда
Okay, well,
получается не
that
то, что
means,
как было у
as I think Voltaire
Наполеона
said,
Бонапарта, надо было
that
быть.
if,
Получается,
if
что
if it wasn't the case, it had to
контролироваться,
be imagined,
но
right?
как-то
So in a sense, you can say that
микшировал остроту тех вопросов,
coronavirus sort of
результате
disguised,
по
right,
первой
the importance
инфляции. Если бы
of
его не
the
было.
crisis, right? So in a sense that coronavirus is sort of a cloud with a silver lining. It serves as a disguise to inflation.
Yes and no. I think what the COVID 19 crisis did was to institute and institutionalize the concept that we need both quantitative easing, a monetary policy, and we also
Mm.
need to have a huge fiscal dominance into the economy. So, in other words, where the other crises that we've had has been driven on the Fed put, the Greenspan sort of way of dealing all the way back to 1998 with the LTCM crisis. That has continued, but now also you see governments spending a huge amount of money. We have the biggest debt to GDP ever in the government sector that we will ever see. Well, not what we ever see because it only gets bigger. But all of that money, 90% of that money goes back to the theme we had before, which is to put money into decarbonization. But if you decarbonize, you are metallizing the economy because whether you want to build windmills, better grid system for electricity, batteries, what do they all have in common? A huge amount of metals and mining products. And those mining and metal products cannot be produced because they are under the control and regulation of ESG. And of course, there's not a single ESG rating agency in the world that will allow mining companies to be seen as being relatively good for the economy and good for the climate. So we have a sort of a catch 22, I think is the word for it, where we continue to repeat the same mistakes. And what I think is super interesting is that, so right now the market over the last couple of days has corrected a little bit and people are getting nervous. So immediately people look for more liquidity. But listen, more liquidity will make the inequality and the financial asset go up even more in price, creating additional need for fiscal spend. More fiscal spend will make the physical world, which is already too small, even smaller. So for the first time since all of these crises have materialized, we're actually dealing with both liquidity and the world being negative.
Well, with that, I was wondering. So, probably the second most important topic after the coronavirus is the Fed policy. Because, as you said, the unprecedented stimulus and many believe that this is like the foundation for the economy. They sort of save the economy, and they believe that it is the foundation for all other investments. So, what should we expect from the Fed, and how will that impact in the market in the future? Well, aside from the fact that Jerome Powell, I think, on 26th of August, besides of everything that he said. So, if indeed we start seeing the tapering. So what should we expect from the Fed in case of tapering?
I think it's very rare you and I disagree, but I think the Fed doesn't mean anything anymore. The ability of the Federal Reserve to do anything to the economy which is positive is non-existent. So the Federal Reserve and central bank globally has outplayed their role. Having said that, of course, I know your question is relevant because 90% of people watching this show will think that Fed is important. So let's pretend, at least in my world, that Fed it matters. What will happen on the Fed taper is that Fed will probably announce the taper not this meeting this week because they're too afraid with the market being negative, but in November with a start in December or January. I doubt that the Federal Reserve will ever get to actually execute big parts of the taper because what is going on right now is that we have a significant slowdown of growth, mainly because of base effect of course of the huge stimulus last year, but also because if you take the case of the US, it's very difficult to get an additional stimulus. So what we're having is very interesting in the dynamics, and what is facing Fed is that very much at the time where they want to be hiking or tapering interest rates or tapering the support for the economy, they are actually doing it so late that they are risking that the economy is already in a slowdown, which classically would mean that they need to spend more money and more liquidity. So what we will have is probably that as we come into the late part of this year, early next year, we will see that the US authorities will start to spend money again because we're going into the 2022 midterm election and the political establishment always likes to spend money. So for me, one, we're going to get taper and it's probably going to start in December or January. It doesn't matter. Why doesn't it matter? Because the economic background of the US is such a significant slowdown and such a erosion, a hollowing out of the disposable income. That additional stimulus is coming. That additional stimulus goes back to what we already discussed, will just mean that the physical world gets even smaller than it already is, which means that we could probably have a catch-up effect on both inflation and interest rate, not driven by the Fed, but driven by the byproduct of what Fed is doing.
I always thought that the Fed, given the chance, would bring back the ability to somehow influence the rates. At least will hike by 0.25 from these levels. I thought so. I thought that they will do it this year, but maybe I'm wrong. Maybe they will not going to start hiking this year. So am I right or am I wrong? Is there a chance that the Fed will at least try to start hiking by at least 0.25 somewhere this year?
No, not this year. It's impossible. Simply because with Chairman Powell, you have a chairman who have changed the inflation mandate, which you correctly historically used to mean almost as an automatic function that you will hike interest rate into higher interest rate to higher inflation. But this time around, it's about full employment, whatever that means for Mr. Powell. And they've made it so elusive, so imprecise what is full employment that everybody has to guess. So by virtue of that, of course, I think they have lost the ability to actually mean anything for the market. The market is more driven today by the negative real rates overall, which is really their policy minus their policy rate minus inflation. But inflation they cannot control because, as you know, electricity, uh, consumer goods overall, agriculture prices, gas prices, container prices, everything is going up in price, and it's going up by between 15 and 20% in the lower part, and in container shipping rates are up 3, 4, 500%.
Well, and probably one more question about the rates. So, first of all, just as an assumption, this whole year, I thought so, and I've said it many times that sooner or later, some second-tier central bank, or maybe the Sweden central bank, or Australian central bank, or the New Zealand central bank, I mean, those who sort of, because they're small, they're visible. Maybe some of them will start gradually hike rates, and ahead of the Fed. And if it happens ahead of the Fed, then what should we expect if some of the second-tier bankers start hiking rates ahead of the Fed?
Well, it's interesting you mentioned that because I think that the ECB, the European Central Bank, has already started tapering. They don't want to call it tapering, but they are reducing the amount that they intervene, which is de facto a tapering of the monetary policy. So, and you're absolutely right. The small open economies, as we economists like to call them, Sweden, Norway, New Zealand, Australia, looks and is preparing themselves to do it, but they are holding back because at the end of the day, although I don't think US monetary policy per se at this level can do anything, everybody's waiting for the signal to go by the US. No one wants to go it alone into this crisis. But I think as you made the early premise that COVID is going away, I think you're right. I think we will move into that because think about it, there is no real concern right now, despite the fact we have 4.5, 5% inflation rate in the US. The market is still, according to Bank of America's latest fund manager survey, 69% of everybody thinks inflation is transitory. But I tell you what, I am on, at several boards. I am involved with talking to corporate customers around the world. They are all feeling the very real pain of inflation risk, of the inability to source components for their production. And on the energy side, they're paying through the roof 300, 400% more than they used to get the factories up and running. So it's only a matter of time before the inflation lid is taking off, and that creates what you're looking for, your 25 basis point. Because imagine we go into 2022 first quarter, and inflation is all of a sudden 6-7%. And that will mean effectively to maintain the same real rate, which is minus 100 basis point right now in 10-year US, you will have to have US interest rate being at 4 to 5%, which you and I know is never going to happen. So, I think that will force the hands of Fed. So for all strategies, for however you trade, there's really only one thing that can offset this enormous political push toward green and climate and spending, and that is inflation. The only thing that can take down the massive platforms, technology platform in the world is inflation. I mean, second part being, and I think we need to talk about that too, that I think there's a huge amount of regulation coming.
Well, when it comes to our investors and viewers, since the beginning of this year, I always said look at the dollar index and see dollar index as litmus test for what's happening in the world, and basically reference your returns versus the dollar. Is it the right approach? So can we say that the dollar index is the index, right, is the reference, is the benchmark that any investor should actually see his or her return against? Or should we actually use a different benchmark other than the dollar index?
No, I think you're absolutely right. I think the dollar index and the dollar direction is the biggest thermometer that you have for liquidity in the world. So in other words, if there is less liquidity, the dollar is stronger. If there's more, the dollar is weaker. So you're absolutely right. I would add, if you run a portfolio long term, you also need to do the same thing with gold prices. So basically take your portfolio in dollars, but also make sure you compare it to gold, because whatever you think about gold, the gold is indivisible. It's not a fiat currency. It has a limited amount. So I like to understand what my real return is by doing it in dollars and then subsequently do it in gold, because that tells me the purchasing value. So your dollar, make sure that you understand the absolute return of what you're doing. But if you do it against the gold, you have the purchasing power of what is going on. And what you tend to find, of course, in most times is that when there is an inflationary pressure, a hollowing up, a losing of purchase power, then the value of gold should subsequently also go up. So I agree, dollar number one, and number two, do it against gold, and then you're in a very good position to be honest about what kind of returns you have.
Well, thank you very much for that, Steen. I completely agree with you. And you said that we're going to have actually more inequality in the world. And by the way, end of last year, World Bank in their regular report actually said that the global debt and the fact that there's more inequality. So World Bank is talking about that specifically. So to your mind, the importance of these factors in terms of impacting the global stock markets and the global economy, what is the importance of inequality, let's say?
Number one, that we need to realize that governments will spend a huge amount of money to protect the lower income and the disposable income. So what is super interesting is that the response to COVID-19 globally was to protect what we call the lower K, the weaker part of the economy, people who worked in restaurants, businesses, and everything else. So there's huge amount of transfer of support from governments to these businesses. But fast forward to today, we actually have again a less disposable income for people, because the inflation rate has picked up so much that actually the benefit of the transfer of income is still less than what you get at inflation adjusted. Why am I saying that? I'm saying that because governments will continue to transfer money into that sector again. And this is essential part of our conversation today. Whatever we do in physical and transferring money, it is going to make the inequality larger, and it's going to make the physical world smaller relatively to what is needed to happen. All of it is not inflationary. The inflationary part is the world is too small, but the fact that disposable income falls will mean additional support.
Well, in that case, out of the two problems, according to the World Bank, which is global debt increase and more poor people in the world, so if they fight one, they're going to increase the other, right? And vice versa.
Yeah, because and that's super good question. But understand this: the reason why the world has negative real rates, in other words, the fact that inflation rates are higher than the return you get from risk-free money, negative real rates means, as a definition, and this is super important to understand, that there are no productivity in the world. So your question rephrase would be answered the following way. The reason why we don't have the ability to solve for real inequality and for real deficits is the fact we can't grow out of it. How do you grow out of it? You grow out of it by being productive. If every single conversation around the world started with this investment proposal, is it productive? If yes, we do it. If no, we don't do it. Then the world will be in a much better place. So the negative real rates is a very clear signal that the world needs ever lower real rates all the time, because what we are engaging in terms of policy, both fiscal and domestic and in companies, is to be non-productive. So the world is basically, the answer to your question is yes, but it's yes because we are unproductive, and that's what we need to do as investors. We need to be at all time investing into products which have a productivity component to it. That way, you can never ever lose money over time. And if you, I'm just reading the biography by Carnegie, the guy, the steel barons of the 1870s, the 80s, and 90s, the U.S. He was the richest guy in the world. He's still perceived to be the richest guy in the world. Do you know the only thing he focused on every single day, every single company he owned, was productivity? He didn't care about the profit. He didn't care about the margin. What he cared about was the productivity. And I think there's a huge lesson in that. Every company in the world that is run to be productive will make a huge amount of money. Every government that sets out to be a productive government will start to invest in research, in infrastructure, in better internet, in openness of societies, and transparency in legal frameworks. All of this is what's needed. But what are we doing in the world? We are fighting. We are digging down in the trenches, and we have US vacating a huge vacuum in the world, but not wanting to be the world's policeman. You have other actors moving into that sphere, but all of this is not constructive. Making sure that we are not, open and discussing and changing ideas is negative, and that's why we have negative productivity. So hence, the way to move forward is to be always focused as an investor on businesses that are part of the solution to the world problems, not people who benefit, or companies that benefit from the help of the government.
Right. So from traditional monetary KPIs, we need to migrate mentally, so to say, right, to what actually drives performance up, right? Labor performance. It's like in the Stalin, right, time. They used to do it in the Soviet Union a long time ago. But it was done in a brutal way, of course, but he used to do it.
Yeah, no, absolutely. And what we have, I like to, and I mean no disrespect with that, but I call the Soviet Union of the United States the Soviet Union of Europe, because what they are doing exactly is the late 80s in Russia, where the planned economy replaces the private initiative, where you have private capital being crowded out by public capital. Because remember, fighting inequality, doing infrastructure investments, and doing climate change right now, as it works, it's all government projects. So in other words, the increase, there will be increased red tape, increased regulation, and governments will play a bigger and bigger role. And I think you and I are libertarian enough to know that what happens when government gets too involved, you basically have a zombie economy and the negative real rate. So the fact that right now we have all these massive political agendas and a negative real rates is the thermometer. So if you want to measure your portfolio in dollars and gold, what you want to measure the world, how good it is the real rates. If real rates are negative, the world is in a bad place, because that is saying into the long future there is no productivity, no growth.
Well, Steen, you mentioned gold, and I've been thinking for the past 2 years that gold is at a historical milestone, that at least it has lost sort of 50% of its protective asset qualities. So what's your take on gold as we speak? And do you agree with the fact that gold is sort of one foot out of the door, so to say, 50% still sort of protecting assets, and the other 50% is trying to sort of reinvent itself as an asset?
I somewhat agree, but I think you and I, at least I need, with the lack of hair I have at my age, I need to realize there is a group of investors around the world, let's call them the under 40-year-olds. They don't see gold as a protector, and they think that that is to be found in the crypto and technology and blockchain. Whereas I think the elder generation, who for the record owns the biggest chunk of assets in the world, still feels that gold is the right tool. I think the difference here is that crypto has been around for just over 10 years. Gold has been around for thousands of years. I'm pretty sure if world goes into a tailspin, I would rather be long gold than crypto. But I do, as you know from last time in my 100-year portfolio, I do have 7% allocation to crypto. So it's not that I'm afraid of it. But I think there is a competition between crypto and gold. But I do think, however, that ultimately when inflation and the bottle comes off. Don't forget that gold is reacting to the fact that 69% of all investors think it's transitory. So we still have a long way to go in the mind of investors that inflation is a massive outperformance of gold.
Well, I myself is still a believer that inflation is sort of transitory, because when Powell said that is a kind of a horse that they actually have under control and all that. And then in June, I think there was a report from Bank of America, and they said that inflation is not transitory at all, because Bank of America said it's actually a long-term thing. So there's a bit of a disagreement between the bankers and the Fed on this.
Yeah, and then there you know what to do. You have to disagree with the central bankers. I mean, I like to say I have a golden retriever. She's called Nelly. She's better at predicting the economy than the Fed at any time. She has a 50-50 chance, but Fed is wrong 99% of the time in terms of their economic predictions. So Fed is always late. That's the way they conduct themselves. That's why they do how they do the policy. I think you only need to look domestically to have a central banker who is a little bit more alert to the inflation risk. I give full credit to your own central bank governor. She has been on top of this. She's been talking to the point that is a real issue. And I think she's managing and doing the right thing relatively to a very dogmatic Fed, which insist on being right despite the fact they've been wrong ever since the start of QE. Don't forget, the inequality is entirely almost driven from the fact that we have quantitative easing, print of money. The trickle down effect, per definition, per design, will make sure that financial assets has excess return relative to labor and investments. Hence, of course, you if you continue to do that for 10, 15 years, you get where we are today, the highest stock market ever, the highest housing prices ever, the highest energy price to disposable income ever, the highest inequality ever, and a political climate which is so focused on one agenda only, the climate change, that they forget that to solve for climate, we need long-term solutions that are productive and that are, embedded into a scientific approach, not to something which we hope and dream for. And make no mistakes, I am for climate change. I am for a better life with nature, but it's not going to come from renewable energy, which we clearly see right now in Europe doesn't have the baseload effect on creating electricity.
Well, speaking of that, speaking of the bubble, I mean the fact that we've been hearing, from many people that there's a bubble on the market, right? So they say that the multiples don't make any sense. That look at the Buffett indicator, etc., etc. So everybody talks about that. It's just the market is overbought. Yet the market keeps creeping up, keeps going up and up and up. That means that either the market is really overheated, and that's got to be like a super massive bubble, or maybe the multiples don't work anymore. Maybe the way we value companies and assets don't work anymore, and we need something else, some other way to measure companies' value other than the traditional multiples.
Number one, models always work. So it's not the models that are wrong. It is the incentive structure this is wrong. Charlie Munger, who is the partner of Warren Buffett, said a very smart thing. He said, "Show me the incentive, and I predict the result." If you have negative real rates, if you have massive amount of monetary support, you have this, as you call it, the market's going up despite the multiples being high. But over time, multiples will come down. Having said that, it is pretty clear that anyone who traded the market based on the liquidity available has done extremely well. Anyone who's been looking at the models of PE values and metrics and forward-looking guidance and everything else would have done poorly because the market has been overpriced. But as you and I talk today, we in Saxo we have a model which uses the seven biggest model in terms of measuring valuation. We've never been more expensive. We have never been more at risk in terms of the convexity, i.e., the risk for a very small move in interest rate to have a massive impact on negative on the stock market. So it's like everything else. We tend to think that the immediate last 10 years is the most important, but when history of time is written, this will be an excruciating bad time for everybody, because what you've done effectively, of course, is to make sure that the capital gains is all today, whereas the future return will be much slower because, of course, that's mathematically a fact. If you have a very high PE when you buy a stock, doesn't stop you from making money, but your absolute return will be lower. Whether you buy stocks at 40 at 1, the ratio, of course, is 40 times different, the potential upside. So, we can't run away from gravity, economic gravity. We cannot run from away from models will work, but we have unprecedented times where liquidity has been positive. And that is my key point. My key point is that we are at a turning point in the economic system where more liquidity will make things worse, where more fiscal spending will make things worse. Fiscal spending because we are physically not capable of dealing with it. In terms of more liquidity, why is that an issue? Because it will increase the social inequality. It will increase the what I call the culture war going on between the young and the old, between the governments and private capital, between uh, platforms and privacy, between enforced government spending and free marginal cost of capital. All of these culture wars is going on. You see it in the election across Europe. You see that they are turning to green. The younger people want a different agenda. So yes, there is cost to it. The model does work, but the model has been very slow to adapt to what you rightly describe as the effectively it is the best 10 years in the history of modern finance for return on assets, but it's also, and we need to realize that, the worst 10 years for inequality. It's never been more difficult to get access to housing if you're young. It's almost impossible to get access to education. It's almost impossible to have access to all of the goods that the older generations have. So I tend to think socially, the biggest issue we have across the world is between young and old, not necessarily between poor and rich, because that is already into a stratigraphy. But the dynamics is that between young and old, they have a dynamic process because the young can vote. They're becoming a bigger and bigger part of the electoral college in the US, in Europe, and they are going to turn up and they're going to say to people like me, the over 50 years old, they're going to give you the middle finger and say, we don't care what Mr. Jakobsen thinks. This is all about, we want our own rights. We want to be part of this economy. We want to be partaking in the upside of the economy as well. So big changes are coming on that note, and that's why ultimately the model will work.
Okay, well, other than the global inflation, I mean, they're also discussing potential dollar devaluation. So, and there are some really bold, forecasts. That we have at least several people in Russia that have been predicting the gloom and doom for the dollar. So, what's your personal take on these forecasts for the dollar devaluation? And is it really a major trend? Because, on a regular basis, keeps coming up from some politicians that, dollar this and devalue it, etc., etc.
I'm a big friend of Russia. I've been coming to Russia for 20 years, but the one thing I love about Russia is there's always a good conspiracy theory that I need to address. So I love these kind of questions, and of course in Russia there will always be more people who will see this. And I mean this is as you know, I do the outrageous predictions, so I do love conspiracies per se. But having said that, I think you're right. I think we are at a turning point. So if we reach the limit to which the real economy can cater to the fiscal and monetary world, there's also the fact that the Nixon doctrine, which was the when the U.S. left Vietnam in the 1970s, they he said Nixon said that he wanted to withdraw the US from being the world's policeman. So they changed the outlook to being, we will, if our friends help themselves, we will come to their rescue. Now, with Afghanistan and everything else, they're actually withdrawing even more, and they are pivoting towards facing what they call the competition of China. I think it's partly because of economics. They can't afford to be involved in all of these overseas territories, but it's more importantly that they need to focus their strategy towards China. Why I'm mentioning that in the context of dollar, of course, is that you know the beauty of being the hegemonic power of the world, of being the biggest military power by being involved overseas, is that, and then running the deficit you do in the US, is that you are catapulting money into the rest of the system, making your currency the one that everybody needs to pay with. if you no longer are involved overseas, if you're withdrawing your overall support for the rest of the world, one minus the dollar float means that you have less capital. The second part is that the deficit in the US is now going to be between 5% and 10% of GDP from now to 2050. That means that the domestic saving in the US is not big enough to actually pay for that. So you need foreigners like you and me to buy US Treasury bonds. In order for us to buy these bonds, either the dollar needs to be cheap or the interest rate needs to be high enough. We both know that the ability to get an interest rate way up is very difficult because they can't afford it. So the only way left by deduction is to get a weaker dollar over time, which fits into this tectonic plate move where US is withdrawing from the world and becoming more domestic. The risk they have, and I think this is a policy mistake, is that they are so dependent on foreign funding that they probably need to do both a slightly higher interest rate but a significantly weaker dollar. So I think for the first time, I will align myself with the Russians that seems to think that the dollar can lose value. But remember, 90% of all cross-border transactions today is in US dollars. So I'm going from being the global currency to not being it is not something that happened overnight. But I do expect over the next 10 years that we see a gliding value of the dollar. I think there'll be increased significance for the emerging markets. I think the euro, the Swiss, the sterling will have a revival. I think Russian ruble, as I always say, I still think it's good value. And I think, of course, the Chinese currency will also have a major impact despite everything that goes on.
So basically, Stephen Roach's forecast, which is 35% devaluation, which is way too much, sometimes even for Saxo's outrageous predictions, right? You think it's too much, minus 35%?
It will fit into the outrageous prediction, but as you know, outrageous prediction is not Saxo's official forecast. So outrageous prediction, it could very well be inside. But in terms of my official view of the world, I think we are more looking at a 2 to 3% devaluation every single year. And by the rule of 72, that means over the next 25 years, we'll have a halving of the value of the dollar.
So Roach might come true, but over a long, long time, right? Basically.
That's generally how the market works. It's a marginal step-by-step process. So 2 to 3% every year on average. Yes, absolutely. I think Rose is right about the direction and the magnitude, but I think it will take a longer time because you're not, you don't go from being the biggest to being the smallest in 2 seconds.
Well, a very important factor for the market is that we are seeing tremendous number of rookie investors, novice investors, and we're seeing a lot in Russia because, people don't like the bank rates anymore, so they want more returns, so they withdrawing cash and they're reinvesting it into stocks and whatnot. So to which extent is it a factor for the market? Because they say that now we actually see social networks starting bumps and dumps and, swaying investors and this or that. And say that for the first time, retail investors are now the power that actually defines multiple trends on the stock market. So what's your personal take on this new phenomenon, the power of the retail investor? So is it no longer a backseat driver? So is it now the actual driver in the front wheel, or is it still an illusion? What is the role of the retail investor right now?
Of course, the answer is somewhere in between, but the overall retail volume as a percentage of the total volume is between 10 and 15%. So not significant, but important. But what has happened is that the retail investors, especially that segment you talk about, has smartened up. They've become very clever about what they do. So they tend to go to uh, stocks and titles which are very small and very manageable in terms of speculating. So they use call option and put option, and that way they create leverage on the trade. So I think the correct answer is that they are not yet significant enough to make a huge difference on the overall market, but in individual pockets of the market, they are extremely dominant, in particular in stocks that old people like me don't want to look at because the stock is worth nothing and they manipulate on a story or a meme or whatever goes on, and they use what we know in crypto technology to be the network effect. So they create a momentum to do it. So I think for individual stocks, absolutely they are important. For the overall market, they are still insignificant in terms of the what they do to the market.
So, but in terms of their total capital, can you say that the total capital of retail investors actually surpasses the, say, Warren Buffett's capital?
Certainly Warren Buffett's. That's not very difficult, but but it's not very big. I mean, it's a difficult question because you have to remember, it is not how much capital is deposited with brokers. It's how much of the capital is being traded. So hedge funds are very important for the direction of the market. Why? Not because they have this biggest pool of capital, but because they have leverage. They are leveraged 10 times, 15 times, 20 times. So their ability to use a small amount of capital to have a big income is very big. Retail investor works the other way. If we take Saxo as an example, we have 700,000 clients, of which probably half of them only have 2 stocks. They never trade anything, but the money is sitting here. So they have a very large AUM with us, but they don't have a huge impact on the flow we see. That is driven more by traders and hedge funds and central banks than it is by these retail. So you're right in assuming it's a big amount, but you have to remember the value of that big amount is the amount times how much is the value, the stock, the money traded in the marketplace.
Well, is it my understanding? Because, well, when I talk to my viewers, because, well, I hate leverage. I always say, do not use leverage unless you're super duper professional. The risks are too high. Is it my understanding that you are more loyal, more liberal when it comes to using leverage? So, are you against leverage or are you in favor of the leverage?
I'm in investing. If we're talking about investing, I'm 100% against it, like yourself. If I'm about, and I've been running hedge fund in the past, of course, I'm leveraged because it's an efficient use of capital, relatively speaking. In the most hedge funds levels, you can run 5, 7 to 10 times the capital. But it's really, you have to remember it's the same thing. So say I want to trade for $1 billion line. The only difference is to raise that, I only really need $100 million if I'm a professional. If I want to trade $1 billion as a private, I need to raise $1 billion. So you're absolutely right in what you're telling your viewers, that stay away, because that is the end of it. Remember, people that lose money in the stock market normally don't lose money because they are wrong. They lose it because they're over leveraged. And that's certainly, it's an evidence I've seen over the last 30 years. It's always the leverage that kills. It's not that people do something wrong.
So, Steen, and that's all the questions that we have for you. Thank you for your incredible wisdom. I think this is very important because for the past 15 years, I've been actually reading your, analytics, and then I've been a huge fan of yours, as a matter of fact, for 15 years, including outrageous forecasts, something that is always very useful and gives you food for thought. And hopefully, of course, you will be back on our channel in the future.
I will, and I hope we can do one with the outrage prediction, which come out, I think, the first week in December. So I'll be an honor to be on your guest if you want to do something around that, for sure.
Absolutely. Everybody's looking forward to it. Absolutely. Thank you so much, Steen. That's all the time we have. Thank you.
Thanks for having me. It was a great pleasure.